Good morning, or afternoon, or evening, depending on where you are, and welcome to this new session of the International Macrohistory Online Seminar, jointly organized by the Graduate Institute in Geneva, CEPR, and a wide consortium of universities all around the world. My name is Stefano Battilossi from the University Carlos III Madrid, and it is my pleasure to welcome today's speaker, Gert-Jan Verdicht. Gert-Jan holds a PhD in financial economics from the Antwerp University, and he is now an assistant professor of finance at the Catholic University in Leuven. For those who don't know him, his research interests span corporate finance, asset pricing, and financial history, and he has published recently in the Journal of Empirical Finance, the Journal of Economic History, and Explorations in Economic History. The paper he presents today is a joint work with Gustavo Cortés from University of Florida on public health shocks, product pricing, and risk management in the US insurance industry during the flu pandemic of 1918-19. Before we start, let me remind you briefly the rules of engagement of the webinar. The seminar will run for an hour. Gert-Jan will talk for 40 minutes without interruptions. And then we will have 20 minutes for discussion. After the end of the formal session, we will have an extra slot of 15 minutes for those who want to continue the discussion in a more informal way. If during Gert-Jan's presentation you have a very short clarification question, please flag them in the Q&A space, and I will interrupt Gert-Jan briefly to allow him to clarify. During the presentation, you can also write your questions and comments again in the Q&A, and then after the presentation, I will pass them on to Gert-Jan so that he can answer. Without further delay, Gert-Jan, the floor is yours.
Well, thank you, Stefano, for this very nice introduction. So I'll put on my video as well. I hope you can see my screen now.
Yes, we can.
Perfect. So thank you so much for allowing us to present and giving us the opportunity. So as Stefano mentioned, this is joint work with Gustavo Cortés, and today we're going to talk about public health shocks and product pricing. So we are going to focus on life insurance companies during the 1918-1919 influenza pandemic. So before we start, let me just clarify the title by itself. So we're focusing on product pricing. Within the life insurance sector, you could also call this premium pricing. So we try to fit this in the larger literature, as I will discuss later during this presentation. So what is the motivation behind our work? Well, we focused on the public health shock. Why? Because most of the literature so far in the insurance industry or in the insurance literature focuses on financial crisis, financial shocks, financial frictions. So one of the more influential papers in this literature is Gron and Winter, who talk about capacity constraints, basically saying, well, non-life insurance companies are going to adjust their pricing due to the fact whether or not they have more capacity to take on new life insurance products. So they say, well, there is a life insurance underwriting cycle saying you have soft markets, hard markets, depending on the amount of coverage one company can take on. Then more recently in the American Economic Review, you have Cohen and Yogo, who says that life insurance products are priced based on financial and product market frictions. So competition seems to be driving a lot of the variation in premium prices. They also say that companies with a larger balance sheet shock actually reduce their prices on new life insurance products. And then more recently in the QG this year, you had G, who says, well, if you have a company with both non-life and life insurance, then a shock in the non-life insurance department will transfer to the life insurance department, also leading to lower prices. And why lower prices? Because she concludes, or she argues, that life insurance companies want to raise money more easily. So they, she mentions there's a decrease in price for those products that translate to immediate income. But also in a larger literature, you have Kim in 2020, who mentions that companies more closely related to the Lehman Brothers bankruptcy are also going to decrease their prices more as a fire sale type of behavior. So all of the papers who focus on financial shocks, financial frictions, say, well, firms or insurance companies are actually going to decrease prices. Now, we in this paper wanted to focus on what happens during a public health shock, because a public health shock by nature is way different than a financial shock. So that is going to be the key motivation of this paper and our main research question. What happens during a public health shock? And we think this is interesting because in general, there is a problem with data availability. So right now we're still in the middle, unfortunately, still in the middle of COVID-19. So we cannot really infer much of conclusions regarding this pandemic because it's still ongoing. Whereas in 1918, 1919, the data is already there. It is online. We can digitize it and actually study how a past pandemic, global pandemic, actually influences these types of companies. So what we do, we actually go back 1 century to the influenza pandemic, and we focus mainly on the US. And what we do specifically is we try to exploit the variation between companies, life insurance companies, towards their exposure to this pandemic. Because as I will talk later, we actually know where all these companies have business. We know how much they were or potentially were affected by the pandemic, since we can match this with mortality data to get a clear sense of how firms actually behave in light of a pandemic. More specifically, we focus on life insurance companies because, first of all, a life insurance product is a homogeneous product. Especially in this time, there was little variation in the type of products there was, and also regulation, although it was on a state level, was somewhat similar. There were some variations in regulation, but across the board, it was relatively homogeneous, which we also show in our regression analysis. Now, one thing which makes the life insurance sector particularly different from other industries is that the customer is also the debt holder, right? If you buy a life insurance product, you actually hope that when you die, the life insurance company pays out whatever is being owed to your family members. So in that case, it's somewhat of an interesting sector because price changes and change towards financial health can translate immediately into the health of the company itself. And we also argue that it's maybe the most affected sector because on the one hand, life insurance companies pay out a large amount of money in death claims. Also, they receive fewer income, ceteris paribus. And also, if like in COVID-19, the public health shock is also coincided with a recession, this can also be affected through less demand for life insurance. So therefore, we think, given the fact that 1918, 1919 did not really coincide with the recession, history can really help us to better understand how the pricing behavior of specific companies is affected by the pandemic. So I already want to highlight our main conclusions. So we show that high exposure life insurers actually charge higher prices. So this goes against what we find in the financial frictions literature, where they show a decrease in price. Now we show that they actually charge higher prices. And this increase in price is really unaffected by other market frictions, such as competition, such as the leverage or financial frictions in that regard. We also have narrative evidence that it was the firm who adjusts their pricing behavior and not so much customers. So overall, we see an increase in demand as a consequence of the pandemic, but it was an increase in demand across the board, across all ages, not so much in different age cohorts. And lastly, we also show that these conclusions hold for both new life insurance companies and also distressed life insurance companies. So if you take those type of firms into account, these results remain the same. So we argue that since high exposure life insurance companies charge higher prices, this is more driven towards a risk management type of story. So we argue that risk management is at play, because it also really impacts entry and exit decisions, as I will show you later, that an affected life insurance company is more likely to exit an affected area. And overall, it also increases the fragility of the entire sector, which is in line with current research as well. So let's dive into the paper itself. So first, I'm going to give you a primer on the influenza pandemic and highlight the specific elements why this is important in our case. So the first case in the US was in Kansas in March 1918. It was brought in apparently or allegedly in the US due to World War I. Now, the first wave, although there were many cases, was not very severe. The more deadly and more severe wave came in November 1918 throughout January 1919. That was across the US and highly infectious, very deadly, unfortunately. There were some minor local third and fourth waves, for instance, in New York in 1919, but these were of less important events. Now, what makes this historical episode so appealing? Well, it was very severe. So case fatality ratio was 2.5%, which is somewhat similar to COVID-19 last year in March. So in that regard, those two pandemics were relatively similar. Now, a very distinct feature, which is important in light of our study, is it affected younger adults much more. So the mortality rate of younger adults, so around 20 to 40, was significantly higher. If you're a life insurance company, this becomes very important because you make actuarial predictions on how much reserves do we need to put aside to cover for these young adults. Well, since they're young, you're less likely to put away a lot of reserves. So that can really affect a life insurance company. And as I already mentioned, it did not really coincide with an economic downturn as it did nowadays with COVID-19. Also at that time, and also somewhat important in our case, is World War I. So as I mentioned, the first case in the US was a veteran soldier in Kansas, but World War I in general could also play somewhat of an effect in the sense that there were some life insurance companies that also offered their services to veterans and soldiers. However, the war risk insurance in the US offered most coverage for veterans. So this led to the fact that the majority of life insurance companies were exempt from covering this type of diseases or mortality. So in that sense, the majority was exempt, but still we take into account the effect of World War I within our regression analysis, because we do not really know how much of these veterans were being hurt in World War II. We have some narrative evidence that was less important, although still economically significant. So then we actually turn to the data. So we are focusing on the life insurance sector, and the data, as I will show in the next two slides, contains balance sheet information. So we have total admitted assets and in which asset classes the life insurance companies actually pay out or actually invested. But we also have total liabilities. We have a lot of the most important corporate finance and life insurance variables in place. We also have the income statement where we focus on total income and total disbursement. We also have an idea how many clients and contracts actually terminated and the reason why they terminated, for instance, due to death or they lapsed or they just retired. Also, we have a lot of firm-specific information, such as geographical diversification, how much business all of these life insurance companies have in specific states. We also know the retirements of these life insurance companies as well. So this is all the data we're going to use. Our source is The Spectator, which was a very reputable source at the time. So we include all life insurance companies with at least 1 year of data pre-1918. We're going to exclude all retirements, and with retirements, I mean bankruptcies. So retirements is the synonym for bankruptcies in this literature. All retirements we're going to exclude before 1917. And within the main section of our regressions, we're also going to exclude new incorporations. The new incorporations we're going to include later as a robustness check, whether or not our results make a lot of sense. And our secondary source is BEST, which is still around today, just to clarify if we made any mistakes or if any data was unreadable, to get somewhat of a backup check in that regard. So to give you an idea what this data looks like, so for each company, we know in which state they operated or which state their headquarters was. We know capital stock, new premiums, renewals, total new premiums, premium income, total income, disbursement, also some commissions where the cost actually came. Also liabilities, new business, as I mentioned, new issues, also the terminations by debt maturity, expiry, surrender lapse. So this is just a snapshot of what data we do have. It is relatively comprehensive, so which was very nice for us to actually make our empirical design. So to give you an idea of the data once we collected it, this is the amount of business life insurance companies did throughout the US. So you see it's relatively diverse with a large focus on Midwestern states, but also in California, Arizona, Texas. There's a lot of business across the US. So this is something we try to exploit, large variation in business, large variation in mortality. Let's combine those two in a regression analysis. So then we actually go to the main important variable in this case. So we are defining price as the value of all new contracts divided by the number of new contracts. So basically we have the average value of a new contract and we take out inflation because we're going to measure everything in 1970 US dollars. So therefore, our definition is the average price of a newly issued contract. You could also interpret this as the value of a single premium contract. To give you somewhat of an idea, summary statistics, the average new contract was about 1,837 US dollars, which is relatively large, given the fact that the average wage in the US at that time was about 3,500 US dollars. So this is economically meaningful, at least. So we have a lot of control variables, which are relatively standard, both in corporate finance and in life insurance literature. So we are going to focus on the log of size, asset growth, also operating profitability, leverage, liquidity. Then geo is going to be our measure of the number of states where a specific life insurance company has business, and capacity, which captures, as I mentioned, how much capacity do you have to take on new specific projects. So the amount of liabilities divided by the value of new contracts. And then lastly, to capture the effects of World War I, we're going to use the data from Eric Hilt and his co-author to capture the distance, the minimum distance towards a military base. So to get some sense of population's density and also the effects of World War II. That's also something we're going to take into account. So some summary statistics. So as I mentioned, the price is about 1,800. So on average, there were a lot of states where they have business in, about 9 states. The size of these companies on average was about 1.9 million US. And to put that in perspective, the average size of a bank during this era was smaller, which was 1.2 million. So these companies on average are larger than the average bank. So this is the full sample. What we're going to do next is combine the mortality data with our actual business data. So we are going to calculate a firm level mortality variable to see how exposed these companies were to the pandemic. And then we're going to take the mean of that mortality, of the industry mortality. If you're above the mean, then we label you as a high exposure firm. If you're below the mean, you're going to be a low exposure firm. Now, in a robustness check, we're going to change that empirical design somewhat, but that is going to be our key idea. So to get high exposure and low exposure, you see there's some differences across these firms. For instance, the high exposure were bigger in size, had obviously significantly higher mortality, had fewer cash holdings on their balance sheet, were active in more states, had more capacity to take on projects, and had lower asset growth. So these are just to show that there were already some differences between those companies. So what do we do next? Now that we have all this data, we're going to run a difference in difference model. So our main analysis of interest is this high exposure times post. So high exposure is equals 1 if your life insurer's level mortality is above the industry average. Post is going to be an indicator variable from 1918 onwards. So our data stops in 1922 and we start in 1911. And then we have some control variables, which we are going to lag. And also we're going to include that distance to post to control for World War I effects. Now, in this analysis, we're also going to include year and life insurance fixed effects to capture somewhat of that heterogeneity. And we're going to cluster our standard errors at the life insurance level. So our findings are, first of all, our post variable is always statistically significant and negative, which means that after the outbreak of the influenza pandemic, life insurance prices went down. So this is in line with the findings of financial frictions. Then we find also negative price trend after the outbreak of the pandemic. Now, more importantly, we show that post times high exposure is positive and statistically significant, always above 5%. So this means that prices actually increase for high exposure companies. So there is a positive and significant price difference between those companies. Now we also... Yes.
There is just a short clarification question. Bert Kramer asks, is high exposure time varying or constant within firm?
Constant within firm. Thank you for that question. But as I will show you later, we're also gonna tweak with that a little bit. So, but it's constant, yes. So as I was saying, we're also going to include some control variables. And for instance, in table 5, we're going to exclude all life insurance companies that went bankrupt to see whether or not they were driving the results and that is not really the case. So this is positive and statistically significant and also economically meaningful. So to give you an idea, this coefficient corresponds to $2,300 in 2019 dollars. So this is huge. So the main takeaway is just from this table: high exposure charge higher prices, so higher premium prices. This effect is statistically significant and also economically meaningful. About $120, but the equivalent of $2,300 in current prices. Now, a separate question then, is this effect the same across the pandemic? So what we're going to do is we're going to run an event study type of analysis where we replace this post with year dummies to really see what the impact of these price differences are across all years. And that's what we find. So first of all, we find that there is no parallel trend happening, but also that in 1918 and 1919, most of the difference in pricing actually occurs. After 19, so after 1 year after the outbreak of the pandemic, the difference is not statistically significant anymore. So at the height of the pandemic, that's where the main pricing differences are, and they're significant, up to 5% statistically confidence level. So main takeaways: they charge higher prices. But now, a bit coming to Bert's question, what if we change the treatment period somewhat? So what we're going to do is we're going to throw out all of the life insurance companies who have a mortality rate below 75%. So from 75% onwards, to really try to measure the most extreme cases. We're also going to throw out the control group, and those companies have a mortality rate between the median and the average mortality rate. We're going to throw them out to see whether or not there's any difference regarding that. What if we do a placebo test, and we assume that the influenza pandemic occurred either in 1915 or in 1916, and see whether or not that has an impact. And we obviously assume that doesn't have an impact on our results. And then lastly, we're also going to focus on new incorporations, see whether or not high exposure firms differ in terms of pricing versus those new incorporations. So first, if we change our treatment period, and if we only include the most severe cases, then we still show a very significant and even more economically meaningful change in price. If we change our control group, that doesn't affect our significance and the magnitude to a large extent. Now, then, as I mentioned, we're also going to run a placebo test, where we're going to assume that in column 3, either the pandemic took place in 1915 or in column 4 in 1916. And there we do not find any evidence of pricing changes at all. So this again shows you that we do find anything, and it's because of the pandemic that we find this specific effect. Then versus new incorporations. So we have our high exposure, low exposure firms. Now we focus entirely on the post-pandemic period, but also focus during and after the outbreak. So first, we show that there's again a difference between high and low exposure, which I already showed you. So this shouldn't come as no surprise. But more importantly, we show that there is a difference between high and new life insurance companies. And that difference also takes place during the outbreak of the pandemic. So this also justifies our results, that if you are a new life insurance company, then you also differ from high exposure life insurance companies, but not from the low exposure companies. So again, this points towards the same direction, that there is an effect of high exposure life insurance companies in terms of pricing. Now, what we can also do is ask the question.
Sorry, Gertan. There is another very short question by David Chambers.
Yes.
He says, changes in the control group robustness result is marginally statistically significant at 10%.
Yes.
Can you say a little bit more?
Sure. So that is definitely true, but we throw out a lot of information right there. So it is with every control variable we still incorporate, still statistically significant. Sure, I agree, it's marginally statistically significant, but we throw out a lot of important information in that regard anyway. So we were still happy, even though we throw out that information, that it still points towards the same direction, and also in terms of economic magnitude is still significant. So I agree, it is marginally significant, but it all points in the same direction. That's why we also do change in the treatment group and also focus on these new incorporations, because that all points towards our story that something was going on between these high exposure companies and low exposure companies, or those new companies. So then we try to explain this finding, and there are basically two stories available. Either life insurance companies change their behavior or customers change their behavior. So what we do is we're going to look for measures that capture financial frictions. So we are going to use leverage, liquidity, or also the AHI index to capture competition, or see how many risky investments they actually made, or look whether or not regulation plays a huge role in this regard, to try to capture somewhat of the most important market frictions out there. So even if we control for all of these frictions, the data is still pointing in the same direction. So the result remains statistically significant and economically meaningful. So it doesn't really matter which control we are going to use, we're going to introduce, the results remain the same. So even if we focus on the leverage, and this is leverage in 1917, so pre-pandemic, that doesn't really affect pricing behavior a lot. On the contrary, this points in the same direction, that high exposure life insurance companies actually charge higher premium prices. So we argue this is part of a risk management story, because the AHI was not significant, so competition we can throw out. Financial constraints did not really matter, because leverage and liquidity also didn't play a huge role. Customer changed their behavior. Well, first, we show that there are no real differences in the aggregate demand. There is some narrative and financial history literature that shows that the age of new policyholders did not really change. So we infer that that doesn't really play a huge role. Now, we don't have the actual data to back this up, so therefore we looked for that narrative evidence. So therefore, we really think that this is part of a risk management story. And one key finding to back this up is look at entry and exit decisions. So we're going to look for whether or not companies went to new, did business in new states or more states across the US. We're going to focus on affected areas, and we're also going to focus on these non-affected areas. So basically what we find is, if we focus on the amount of business they do across the US, there's not much of a significant finding going on. So post, yeah, sure, it's a negative and statistically insignificant, but also during and after, it's statistically insignificant. So we cannot really infer much of this. So post times high exposure, also very small, close to zero. Not much we can take away from this. For the affected areas on the other end, there we do find somewhat of an effect, but only after the outbreak of the pandemic. There we find a statistically meaningful effect, and also economically meaningful. So on average, an affected company after the pandemic leaves 1 to 2 states. So given that these companies are huge, this can be economically very meaningful. This also ties very neatly to our risk management story, because what can you do in the short run? In the short run, you can actually change your price, which is what we've shown. We've shown that in the short run, 1918, 1919, those companies charge higher prices. On the long run, however, we show that when the dust finally settled, they can make specific decisions, and then they actually make the decision to leave affected areas if they were a high exposure company. So this to us fits in that same narrative that companies were behaving from a risk management point of view. If we look at non-affected areas, there again, we do not really find any effect. So overall, there's a negative trend, but it's not statistically meaningful, both during and after the pandemic. Post, it is close to being 10% statistical significance, but still not much really going on to make very strong conclusions out of that. Only the fact that highly exposed firms leave affected areas. So then, to really conclude, this paper was about public health shocks and how it impacts product pricing behavior. So we've shown that high exposure life insurance companies charge higher prices, which is against the conventional wisdom within this literature, because this literature suggests following financial shocks that prices are going to decrease. We show the opposite, prices are actually going to increase. It is robust when we control for the capacity to take on new insurance companies, when we focus on where these companies actually did business, the size of these companies, profitability of these companies, the growth of these companies, and also whether or not they were close to a military base. Secondly, it is also robust when we make changes in our empirical design. If we only focus on the most affected life insurance companies, or if we throw out some information with the control group, with companies that are somewhat or close to being highly exposed, then it still points to the same direction, that it's still statistically significant and economically meaningful. And also it holds when we take into account the other market frictions that are being introduced in this literature, such as leverage, such as competition, also demand, or even regulation. So therefore, our main conclusion is that we argue this is due to risk management. These type of highly exposed firms become more risk averse, and that's why in the short run, they adjust their prices. In the long run, there are real economic effects. They leave specific states. Also, in general, we show that the fragility of the entire market as a whole is higher. So the financial stability of the sector actually decreased as a consequence of this public health shock. So with that being said, I think I am done. So I don't know if there are any other questions.
Not for the moment, but thank you very much.
Thank you.
Perfect timing. So thank you for this very interesting piece of research. Perhaps you can keep the slides on the screen just in case there is a question on a specific part of your presentation. That's easier. So just to kickstart the discussion, let me use my privilege of moderator. So I have a question which comes in two parts. The first part is about your ex-ante exposure of insurers to the pandemic, right? So you combine the share of assets by state and then the ex-post excess mortality rates in the state, right? So we know that the geographical variation of excess mortality rates were not random. The two papers by Karen Clay and co-authors you mentioned in the paper, they find basically that the higher or the highest excess mortality rates were typical of cities with low pre-pandemic health status of the population, higher incidence of poverty, and also, interesting, high levels of air pollution. And they claim that these high levels of air pollution comes from coal firing used to generate electricity. So the first question, or the first part of the question is it correct to interpret your high exposure measure basically as an indicator of insurance with a very large share of assets in states with a high concentration of large industrialized urban areas.
Can I already answer that question?
Yeah.
So first of all, thank you for that question, which you're definitely correct that there could be some overlap between the two. However, if we actually look at these high exposure firms, you see that on average, they're active in more states.
Mm-hmm.
So you could also make the case that they can be somewhat diversified across the US. So mm-hmm. it is true that some of these firms, which for instance were active in Boston and only active in Boston, were highly affected by this pandemic. Mm-hmm. However, when we actually look at where these states are, the fact that they are more diversified than those low exposure states lets us to believe that your concern, although valid, maybe can be somewhat diminished due mm-hmm. to the fact that they are more diversified in terms of their actual business.
Okay. So let me go to the second part of the question.
Sure.
So if we read the chronicles or the narratives of contemporary observers, for example, I found this study by Tarbell in 1919, which was quite interesting. So these sources define the period as, I quote, the days of order taking. So basically, the business was growing without any extra drive from salesmen or agents. So, and the business were growing by leaps and bounds. And so basically, they interpret this huge demand shock as something driven by three possible determinants: the flu, the fact that the war risk insurance scheme popularized life insurance, and also they mentioned general prosperity.
Yeah.
Now we know that during the First World War, there was a very huge and positive real wage shock. And this benefited both skilled workers and unskilled workers in the manufacturing sector. And if we combine this with other qualitative evidence that suggests that basically the boom in life insurance before the pandemic and before the war was basically a middle-class phenomenon. So I think they say 85% of mid-class households, according to the Bureau of Labor Statistics. So do you have the feeling that this might imply that there is some important compositional change during the pandemic? So a lot of new clients previously uninsured. I think that Tarbell say men and women who never thought much about insurance apparently have got the habit. So the question is, do you have any indication from qualitative sources that the new policies issued in 1918-19 tapped mainly into the extensive margin of life insurance business, so the uninsured population, a new type of clientele with riskier characteristics, even in the absence of Spanish flu? So blue collars with lower income, lower health status, higher probability of unemployment, higher probability of work injuries and death. And so is there the possibility that as a consequence of the big increase in purchasing power during the war, they can now afford an ordinary life insurance policy? So they upgrade from for example, from the usual low-cost industrial insurance, right? So in this case, pricing would be a sort of a screening device, right? They adjust pricing in order to screen clients because they know that there is a compositional change, which in the pool of applicants, there is a higher proportion of riskier clients. And this high risk is not necessarily related to the flu. It is just the fact that there is a new class profile. So would this, how can we say?
No, but I think I understand what you're getting at. And so if I can, I want to answer your question in two parts. So first,
yes,
it is indeed true that you see a huge increase after the pandemic. So in 1919, there was a huge jump in the growth rate of new policies. Now, there is a very recent paper at the end of 2019 by Joanna Short, who actually tackles the point you're making. And she argues that if you actually look at the people who bought life insurance companies, life insurance products, that the average age did not really change for new policyholders. So that is why we infer that, well, we believe that composition is not going to play a huge role. However, we acknowledge that this is a drawback of the paper because we do not have firm by firm data or policy by policy data to actually know, did for that specific company who was highly affected, did the composition change? We only know from more current literature that it doesn't seem to be the case on average. Because I agree with you in that regard, if the age of new life insurance policyholders increases significantly, that will affect the price mechanically. So I agree in that part. So it could be the case that this is what is being called as a market of lemons, that, maybe those who really need that insurance are more likely to buy that insurance. Or on the other end, as you correctly mentioned, that maybe life insurance companies do not really want or are more selective in terms of the new customers. On the second part, we can say that regulation actually prevented that. So regulation at that time was two main focuses. First, the solvency of life insurance companies, and second, consumer protection. So we do not really believe that is going to drive the main findings. However, we to be honest, we do not know the composition of those new policy holders. On the second part, we actually have a follow-up paper on this, where we show that the profitability of highly affected life insurance companies was significantly lower after. So without taking that huge increase in demand into account. So that actually led to or prevented a lot of financial difficulties within that sector. So without a huge increase in demand, there would a lot of additional life insurance companies went bankrupt, basically. That's what we show in the other paper. So I hope that addresses your question somewhat. Yeah. Yes. I can add one thing now that I think about it is, I know that the Tarbell piece, Short basically says that the flu was the most important aspect, not so much the war and not so much general
prosperity.
Prosperity, general increase in wealth. The flu was the most important element. And that's also something we find in the Spectator, where they said that the flu was the best educational campaign for life insurance companies that was ever created, basically. So, yeah.
Okay, let me just remind participants that if you feel more comfortable, please feel free to raise your hand, and I will try to give you the opportunity to ask a question. Rui, yes.
Yeah, so 2 points. One is clarification, I guess, and the other perhaps more substantive. So you mentioned that you measure the price of this premium by dividing the number of new contracts from the value.
Yes.
So here's a clarification. Were they marking to market the value? Were they capitalizing the premium, or was this a strange world where insurers paid up front everything? Because, typically right? So
It's basically
because then I
similar
don't
to
know how to
market to
interpret the
market.
balance
Yeah,
sheet. Yeah.
yeah, mark to market, similar to that.
So they capitalized the premium on the. I see.
Yep.
Now, under what rules? I guess that goes to the regulation, right?
It somewhat depends from state to state. However, that specific point is similar across the US. Now I have to really go into specifics there, and I don't know it by heart, but I have it somewhat close to me. But I'm not gonna guess here. I'm not 100% sure, but I'll get back to you afterwards on that.
No, that's fine. That's fine. I mean, I also had similar queries along Stefano's last point, right? So the other thing is that we know that the age profile of this pandemic was very peculiar, right? And young people usually do not take up, insurance.
Indeed.
So I'm wondering whether these companies were being treated in the sense that you're describing them, or this is more an intent to treat specification, right? Also because we have more detailed, geographically detailed data on the incidence of the pandemic, and you're just using state level, right? And there was a lot of heterogeneity built around the incidence of the pandemic, even within states, right? So there's these famous cities in the same state, one with a terrible record and the other, hardly hit. But I understand that the panel structure of your data might generate some problem there.
It doesn't really allow to capture that micro level data, unfortunately. So I definitely agree, and we try to come up with some kind of solution to that point. For instance, we focus, or we can focus on the headquarter state, on the headquarter city within a state. So then we can capture somewhat of that variation you're talking about. But unfortunately, on a graduate scheme, we do not really know who are the ones that were being affected, or who are the new policyholders.
Yes, and I guess that was my substantive point, right? It's, I mean, all of this is very suggestive and interesting, but if you can't find a way of identifying supply from demand, it's a bit unclear what's going on here, right? So the literature you cite pinpoints this on restriction on supply. You want to say that's not what happened because companies did move in and out, but that's the big margin, right? The intensive margin would be a much clearer, much easier way to adjust to this. I guess I know the answer, and this will be my last point.
Okay.
It would be convenient to have corroborative evidence in other kinds of insurance, right? If people were taking insurance on all sorts of other things, this might be a demand. You could build up a little bit more the case for the demand effect. And but unfortunately, the obvious case of insurance, related insurance, would be health insurance. But as far as I understand, it didn't exist yet in the US. This was created later, precisely after this shock. But correct me if I'm wrong.
I'm not 100% sure on that point. However, we do have some tests where we focus on companies that both had non-life and life. So to capture your demand to some extent. And secondly, we also try to see how demand actually evolved for both affected and non-affected companies. And there you see the same path, the same increase that in terms of demand and supply. So the equilibrium in that regard, that did not really change between affected and non-affected companies. But I agree that it's definitely a drawback of the paper that we cannot really 100% pinpoint or do a test like it is for sure risk management. We say it's risk management because the evidence of the exit and entry decision also points in that direction. Also, if we compare to new life insurance companies, also within that specific state, somewhat points to that direction, but I agree we cannot 100% pinpoint it with the data we currently have. But thank you for the suggestions.
Thanks.
Before I give the floor to Nathan, who raised his hand, let me bring to you a question from David Mitch from the Q&A. David asked, could you explain the financial frictions argument for why the pandemic shock would have lowered the price of life insurance? Just shortly.
The financial frictions argument was more related in financial crises, basically. There you see that companies with a larger balance sheet shock decrease their price. So what we did was we actually, let me get to it, also take into account the leverage pre-pandemic to see how much does the capital structure of that firm potentially can amplify problems or even maybe prevent problems, to see does that does the amount of leverage that companies have or the liquidity companies have, competition companies face, the regulation companies face, does that change or can that explain why the price of life insurance changes? Because Cohen and Yogo make that argument that those companies who were more affected had lower leverage, actually changed prices differently than their competitors.
Okay, thank you. Nathan.
Hi, thanks for this interesting paper. I mean, following on David's question, and so in what sense, say again, and it follows also on what Stefano and Rui was referring to in terms of disentangling the supply and demand, and so to what extent can you say that, for instance, had not the frictions been that important, the price increases would have been higher or something like that, some counterfactual as to, suppose you're a company in the high exposure and you're doing this risk management, and had there not been these frictions, the price might have increased more than what you're finding in the, because you cannot really disentangle the two, but maybe doing some kind of factual or some kind that would give the I guess some relative impact of friction versus risk management, etc. And it could be interesting. I mean, there's just a way of trying to resolve this, both the literature of frictions, what you're finding, and some of the kind of selection biases that could be in terms of supply and demand.
Yeah, no, thank you for that suggestion. I think it indeed touches upon the points of the previous question. So one thing we currently did in the other paper was looking at synthetic control groups. Try to replicate the situation if, in our case, that demand increase didn't happen, what would happen to the profitability of those firms. So one thing we can easily do is actually look at what would the impact of price be within the synthetic control, so that then we can actually pinpoint it more towards your point about that counterfactual, or we can maybe exploit an instrumental variable approach to get better to the crux of that counterfactual question. So it's a very good suggestion, and we'll look into it. Thank you.
As a very short follow-up to Rui's question about the accounting issue, it looks like the life insurers were responding to the pandemic by cutting dividend payments. So there was a sort of saving dimension in purchasing life insurance, because the insurers paid dividends, and this could be used to build a sort of nest egg, right? And so during the pandemic, they either reduce or they eliminate dividend payments. So I have not a clue about what are the accounting rules for insurance, even less for this period in the United States. But I would ask some expert and check to what extent this change in dividend policy may be reflected in increase in the account of the reported value of policies. So just to make sure that part of the observed price increase is driven by this accounting issue. I don't know whether you have any information on this, or it is possible to get this information somewhere.
So we do have information regarding those payments. So that is something we could definitely look. We haven't done it so far, so I do not know the answer to your question, but it is something that we could explore. Yeah, thank you.
Okay, I don't see any other question in the Q&A, and more importantly, I think that we already hit the hour limit. And so thank you, Gert-Jan, for your presentation. Many thanks to all the participants for questions and comments, for being there. Before we leave, before you leave, if you want, let me remind you that our next session will be on Wednesday next week, October 27. And Emma Rothschild from Harvard University will present her paper, Where is Capital? So goodbye, everybody who wants to leave right now, and we continue the discussion in the extra 15-minute slot. So if you want to keep the discussion going on, please remain with us for the next quarter of hour.
Thank you so much for having us. Thank you for all the questions.
Okay, so I think Rui has another question. I have other questions. So Rui,
thanks.
First.
I mean, it's pretty uncontroversial that there's a differential effect by mortality. So, but just trying to pick holes on your results. So do we have any information? We're talking about life insurance, right? So do we have any information from the industry that they were revising their actuarial calculations on life expectancy because of the pandemic, or they were doing it differentially by different age cohorts and so on, right? That would be a direct evidence on adjustment on the expected cost structure, right? Now, an insurance premium is a financial product, right? So everything goes back to the state of the capital market. I don't know out of the top of my head what was happening to stock returns or the interest rate during this very busy period. What I do know is that there was initially a very big stranglehold on the capital market imposed by the government, who wanted to fund their war bonds and their post-war bonds, the Liberty bonds. And that was disrupting the market. So what was that doing to the asset side of these companies? Now, of course, in order for this to make any sense, the companies in the high mortality states would have to be affected differently by them. And I don't know why they would, but maybe you do.
So I can answer your question in two parts, basically. So first, on the capital markets point of view, this event coincided with the end of World War I, which was a very positive thing. So actually markets went up from 1918 to 1920 onwards. So it was a very, very positive upward trend. For life insurance companies itself, there's not much listed data. There are only 6 companies. For those 6, you see a small decrease in their stock price, but afterwards, after like 2 months, it also increases significantly. So it doesn't really seem that capital markets in general are highly affected by this time period, which, again, I was saying coincided with the end of World War I. Now, on your second point, which is very well taken, I also wrote it down. In general, it is maybe controversial to say, but this was seen as a very positive thing by the industry. And I'm saying this due to the fact that there was this huge boom in demand for these types of contracts. So every narrative evidence we find is saying things along the lines of there's no salesmanship needed. Those life insurance products just sell themselves. You don't need to put any effort into this. So there was a huge inflow of new money, regardless of whether you are in an affected or a less affected area. So therefore, I'm not sure regarding the actuarial adjustments. There is some data on that, but it's fairly limited. So far, the things I have found. But it's definitely worth looking further into. So I wrote it down. So thank you for that suggestion. Because I agree, if we have that information, we can solve our problem to some extent.
Okay, I have Gabriel Misovic with his
Hi, can you hear me?
So yeah.
Thanks. Thanks for the very interesting question. Very interesting paper. I have a very maybe ill-formed question that I've been puzzling over in my mind, and I'm sure you have better ideas about this. So I've been thinking about how you relate this to the sort of microeconomic literature on insurance, which tends to revolve around issues of adverse selection. And so, you know, if you raise your prices, you anticipate that you're going to be kind of limiting yourself to a self-selected pool of individuals who possibly think that they're at higher risk for, you know, exposure to disease or something like that. I mean, how do you think about your findings, which are kind of macro, let's say, mapping onto the microeconomics of insurance and the issues around adverse selection?
So thank you so much for your question. So I can answer that in two ways. So first is the industry regulator basically has two main goals. So solvency from a firm perspective, but also consumer protection on the other hand. So you cannot really increase prices because that's going to hurt your consumers, and you have to have try to have a full coverage basically. So that's on one hand. On the other hand, what we do find, and I should have put it into the slides, but you see a huge increase in the equilibrium supply and demand. So you see the growth of new contracts goes up significantly, also for non-affected, for affected and non-affected companies. So in that sense, it's hard to argue that it's more of a selective. It could be, but to me, it's hard to argue because you see the growth of these new products increasing both in affected and non-affected areas. The only key difference is they charge a higher premium price. So it's not to say that, hey, they just charge higher prices, but they get less inflow. No, the inflow was equal to less affected companies.
Okay, David.
Okay. Yeah, thank you very much. No, I find it a very interesting paper, very interesting study.
Thank you.
First, I think I'm following a little bit more about the financial frictions, but I want to make sure I'm understanding it, and maybe there's still a part I'm not following. So I understand what you're trying to say, or this literature is saying, is that basically with this sort of shock that there are firms that are sort of stuck in the industry and they kind of lower their prices because they sort of can't get out. And I'm still, I guess, not completely clear how the pandemic shock sort of made them more stuck in the industry. So I'm still not completely following if that's really what the argument is about. So that was one issue I wanted to sort of touch on. Second, what comes to mind thinking about it, life insurance in particular, is the old permanent versus transitory distinction. And I would have thought in general, both on the buyer and seller side, that there'd be a focus more on sort of permanent expectations in terms of what's going on. But what's interesting about this could be viewed as sort of transitory, and but apparently there was a big influx on the demand side, even though this might be a transitory shock. And then my kind of final question or comment was, it seemed that with this pricing thing, that even the highly exposed firms, in terms of the exit and entry thing, they really weren't that affected that much. So is part of the takeaway that they really did pretty well in terms of pricing this, in terms of responding to this transitory shock? I was wondering if that's a possible takeaway.
So thank you for those questions. So on the last part, I think I agree with you everything I have read so far is that from an actuarial point of view, these things were seen as being very solid. So we argue that leaving 1 or 2 states is seen as significant because these in general are very large companies and have a lot of business in those specific states. So from that sense, it is somewhat important. But we also argue that one of the reasons why they didn't leave more states is because of that inflow. Because in the other project, we actually showed that the gap in profitability when that inflow of new products was not there is huge. So they were actually somewhat saved by the appeal, the attractiveness of the pandemic for those specific products. And to come to your first point, what that literature says on the financial frictions is indeed correct what you're mentioning. What it also points out is if you apply the law of large numbers, basically, and that is if you lower your price and sell to as many people as possible, you get income very fast. And with that income, you can actually pay out your debt claims to other clients. So this is somewhat as the fire sale behavior, which other papers have suggested that does or can occur. We just argue with using the same type of variables that leverage doesn't impact. So the amount of leverage a company has doesn't really drive our results. Our results come from somewhere else. The main source, the main economic channel is not so much in financial frictions, it's not so much in product market frictions, in competition then, or regulatory frictions. We say, no, something else is at play, and giving the leaving affected areas was also significant after the fact that it seems to be more of a risk management, risk averse kind of story. Because indeed, as you point out correctly, it is a permanent rather than, it's a temporary rather than a permanent effect.
I have a small question about your control for war risk.
Yes.
You use the distance from military camps.
Yes.
And this implies, what is the mechanism behind this? You assume that people enlisted and then waited until they arrived to a training camp, for example, to rush to the nearby town and say buy additional coverage from commercial insurers, right? So I wanted to understand this is realistic in a sense. So I imagine that, especially if you have already a life insurance and you enlist, then what you do before leaving your town is to buy additional coverage from your local insurance, right? So I wonder to what extent, instead of the distance from a camp, you could use enlistment rates by state as a control for the exposure of insurance to a risk. I think that would make more sense simply from the, if you think just, if you try to visualize how these people could actually behave.
So there is one thing we actually did in a separate regression. But we thought focusing on the distance made more sense because you can live, for instance, on the border and 5 miles away, there's this military camp in another state. So you're more likely to go to that military camp rather than to the headquarter city. So we also tried and controlled for what you're referring to, and that also holds. But to us, it makes more sense because one of the arguments Eric Hilt also makes in his Journal of Economic History paper is that it captures somewhat of the influenza pandemic type of
timing.
Yeah. But even if you take that variable out of our regression, the results do not change at all.
They don't change.
So it doesn't really matter whether or not you include it. We just thought it made more sense to include it solely to the fact that we also want to take out mortality following the war.
Mhm.
Because if somebody dies in World War I, that's unrelated to the influenza pandemic, we do not want that to appear in our regression. So that's also one of the reasons why we take this as a control variable.
Okay, I think we have 15 seconds for the last question from Nathan.
Yeah, I mean, this, I don't want to take it, it's just a suggestion and maybe my ignorance, but did you try to look at mortgage markets in those places? Because I don't know, depending, I mean, if there are any insurance clauses in these mortgages, or I guess they're exposed to this risk. And so I don't know the literature about the effect of pandemic on mortgages, but that could be another market where you might find, because these some kind of parallels to this, but it's just a suggestion. It's not.
It's a very good suggestion, actually, and I can put on the slides to show you. But basically, we do control for that as well. So we do have information on that. So we know whether or not they invested in real estate or in mortgage loans. So we use the amount of money they invest in mortgage loans also as a control variable. And there you see if they invested in less risky holdings, that also prices change, but the main effect doesn't change at all. So there, the story actually also points in the same direction, that if you were more risk averse before, you would charge higher prices after. So that also is in the same direction.
Yeah, well, we don't have time, but I was just referring to the interest rates charged by mortgage companies.
I see.
They,
Okay, yeah.
I mean, what's happening there in terms of their management
yeah.
of this risk? And because they're exposed, I mean, so that would be another way to corroborate part of the story, is because these are kind of long-term type of contracts, etc. And
it's a good suggestion. Thank you.
Yeah, I mean, just to look at this.
Thank you.
Okay, I think we have to stop right now, right?
Yep.
So thank you, Gerfian, for your presentation. Thank you, everybody, for your participation and your comments and questions. And we will see each other next week.
Yep.
Thank you so much.
Thank you.
Thank you so much. Bye-bye.
Soon.
Bye.
Bye.
Bye-bye.